let's get the ball rolling. Number one, what type of insurance would be used for a return of premium rider? A, decreasing term, B, annual renewable term, C, increasing term, or D, level term. Here you go, baby. DP's missing. Go ahead and get in the back right here. So what type of insurance would be used for return of premium term? Okay, so let's talk about this, okay? Let's screenshot it and let's get the ball rolling. Okay, so here we go. Zoom in, here we go. So return, oops, too fat. Return of premium, or ROP. This is a type of term insurance that you get your premiums returned back to you. That's what it says, right? Return a premium term. Premiums, refund. So you get premium refunds. Damn, that sounds pretty good, right? You pay for term insurance, and if you don't die, you live, you get your money back. Is that awesome or what? See, the thing is that what they're not going to tell you is that these type of policies, they're also known as, so AKA, okay, AKA, they're called increasing term. Increasing term. So how does increasing term work? Increasing term works like this. Check it out. Increasing term, I'm going to draw it up here. So increasing term works like this. You're going to be paying, let's say $100 a month. And what's going to happen is that your coverage goes up every year. Every year goes up, coverage. So every step that you're seeing right here is a year. So the coverage goes up. See that? So you first start with, let's say you start with, $250,000 in coverage. But then you end up, by the time the term is over, let's say it's a 30-year term. By the time the term is over, you end up with about $350,000 in coverage. You see that? That's called, so this is going to be blue. It's called increasing term. Make sense, guys? All right, so in red, what I'm going to use the red color. Whoa, what happened here? Let's go back. So I'm going to use the red color. It's kind of thick. The red color is going to be level term. So level term, so I'm going to use the legend level term, okay? Level term, let's say you start with $150,000 in coverage, but instead of paying $100 a month, you're going to pay $60 a month. See that? So it's not like you're getting your money back. It's just that the insurance is getting higher because they're using increasing term to get your money back. Does that make sense, guys? So you're paying a little bit more for the benefit to get your money back. Level term doesn't get your money back. You start at $250,000, you end at $250,000, okay? But the premium is a lot less. Okay, screenshot that. I'm done. Okay, screenshot that, because that's going to be a really good way for you to remember what is increasing term and level term. All right, so now let's talk about this. Now that you know that, what's the answer? Well, what type of insurance is return of premium term? Easy, right? Oops, wrong color. It's green. It's increasing term. You see that? So if you remember that return of premium rider is increasing term, then return of premium is increasing term, then you're going to get this question right, okay? So just remember that. Return of premium, increasing term. That's it. There's nothing else to learn on that. So let's go to the next one. If you want to screenshot the rationale, not a bad idea. You should screenshot the rationale all the time. All right. Sounds good, guys. So let's go to the next one. Number 2, the death benefit under the universal life option B is decreases by the amount that the cash value increases for the first few years of the policy, and then it levels off, remains level, or gradually increases each year where the amount of the cash value increases. Ooh, okay. All right, let's screenshot this. So here we go. One thing you need to know about universal life policies, which are also known as flexible premium adjustable life. Raul, why are you telling me this? We're talking about option A and option B. Well, you gotta know that universal life is the only one that gives you options, option A or option B. But while we're at it, I want you to know that universal life is the same thing as flexible premium adjustable life. FPAL, flexible premium adjustable life. So on the test, they might say, like this question says, the death benefit of a flexible premium adjustable life, option B. You see what I mean? So if you don't know that flexible premium adjustable life is universal life, then you're going to get this question wrong. So it's good to know the AKAs, okay? The also known as. All right, so let's talk about this. Option A and option B. Option A, all right, you ready for this? It's called level death benefit. And option B is increasing death benefit. Does that make sense, guys? So, no, it doesn't. What the heck does that mean, right? All right, so it's a little bit complicated, but I'm gonna explain it to you. But based on the information that I just gave you, you would say that the answer is actually D, right? Because it's D. Because the premium actually does increase. I mean the face amount, right? The gradually. So the death benefit gradually increases each year by the amount of the cash value increases. So it's an increasing death benefit. But Raul, how come it's not B? B says also increases. Well, B says it increases in the first years and then it levels off. And no, it doesn't level off. It either goes up or down. All right, it increases if the cash value increases. So increasing death benefit means that if you start at $300,000 in coverage, but the cash value is $10,000, then what are you getting? What's the death benefit? It's an increasing death benefit. So it's going to be 300 plus 10,000 is 310,000 death benefit if that person were to pass away. Level death benefit, option A, says if the coverage starts at 300,000 and then there's $10,000 in cash value and then they die, how much do the family get? The beneficiaries get, in option A, they get $300,000. They lose the $10,000. That's called a level death benefit. That means the 300,000 is level and it never changes, even if there's another $100,000 in cash value. All right, you're with me, guys? Hopefully you're with me, man. Give me a, there's little reaction things. You could go applause. You could go hearts, right? You could go thumbs up. Okay, so I want to see some reaction, man. What's up, guys? Talk to me. You guys getting this stuff or what? Thumbs up, Justin. All right. Oh, Justin, you already passed the test. What are you doing, man? Alondra passed. All right. Thumbs up. All right. Good. All right. If you guys have questions, go ahead.
Just kind of refreshing my mind a little bit. That's why I'm here. I was like, I don't want to just like pass the test. Like kind of like it's good to like just go back and refresh a little bit.
Yeah, man. And you know what? It's good because one day you're going to be teaching the class too and helping your people pass too. So that's good. That's good. All right. So let's go ahead and stop this right here. And let's answer D. There it is. Go ahead and screenshot that, guys. Screenshot that. Increasing death benefit is option B. So remember, option A is level death benefit. Okay. So option B is increasing death benefit. Why does it increase? Because the cash value is going up. So it increases to the cash value. So you get both, right? If you die, you get both. Option B. Option A, if you die, you only get one, which is a coverage amount. All right, enough on that. I hammered it enough, right? Number 3, which of the following elements in an index universal life policy is tied to an index? Which element is tied to an index? Is it the premium? Is it the premium? And the answer So what's tied to an index, right? The premium is not tied to an index. The premiums is money that's going into the policy, and the premiums pay for the insurance coverage and the cash value. Okay, is it the cash value? Yes. If that was your answer, you got it right. The cash value is what is invested in the index so that it could grow and gain interest. So the cash value is the answer right here. Okay. Death benefit, no, the death benefit is not tied to an index, even though it's kind of tricky here, because even though if it's part of it, because if it's option B, then some of the death benefit is the cash value, right? But but it didn't ask if some of it is. It asked all of it, right? Is it the face amount? That's the same thing as death benefit. These two are the same right here, right? This one and this one is the same thing. All right, so it says, which of the following elements, the entire element in an index universalite is tied to an index? The cash value is tied to the index, right? All right, let's go. Be fast, be swift on screenshotting stuff, right? Because we're gonna be going pretty quick. If you have any questions, just type it up, right? Type it up on the chat or unmute yourselves. There it is, guys. Which of the following elements is index universalite policy tied to an index? Cash value. Let's go to the next one. Oh, another death benefit option. Which option for universal life allows the beneficiary to collect both the death benefit and the cash value upon the death of the insured? Come on, guys. Come on. We just went over this, right? Let me help you. It's for sure not going to be B. All right. So not B and not C. Okay. Remember, we just went over this. Option B is called increasing death benefit. And that means that it gets both the face amount plus the cash value. Okay. Option A is level death benefit, and it just gives you the face amount. But Raul, what if the cash value is $30,000? They only still get the face amount? Yes. I mean, so what happens to the $30,000? Good question. The insurance company keeps it. Yep, it's a ripoff. That's right. We replace these policies. We love to replace these policies. These policies are a huge ripoff. Yesterday, I sat down with a client while field training one of our new recruits. And guess what, guys? The new recruit the client was saying, you guys don't sell universal life, do you? And I said, oh, no, we replace universal life all the time because those policies are really bad. And she goes, well, I'm glad to hear that because we were ripped off by a universal life policy. Their death benefit increased and it ate up all their cash value. And now they have nothing, right? And if they would have died, they would have lost their coverage because they had option A. They had option A. Crazy, right? So, okay, so let's go ahead and stop this. And let's go with option, wait, beneficiary collects both, option A. Option A is both. Option B. Option B is both death benefit and the cash value. Yes, PHP loves to sell universal life. And they sell, the specific universal life that they sell is called index universal life. Index universal life. It's a ripoff. Go ahead and screenshot that. Let's go to the next one. All right, number 5. Annually renewable term policies provide a level death benefit for a premium amount that decreases annually, remains leveled, fluctuates, increases annually. Okay, right here, guys, the answer is in the question. Okay, and you could use a lot of common sense on this one, right? So check it out. Annual renewable. That means it renews annually. So for a premium that what? A premium that increases annually. Because it renews annually. When it renews, it has to increase. Why? Because they're older. That's it. So when it renews, the payment increases. Anything that renews, guys, the payment has to go up. Why? Because they're older. Simple like that, okay? There's no other reason. No other reason other than, well, because they're not healthy. No. That's not the reason. Well, because they have more coverage. No. The coverage is the same. The reason anything that renews costs more is because you're older. That's it. Okay. All right. So let's go with D, and that's the answer. We're good to go. You getting me, guys? Everybody's good. All right. Let's keep on going, man. We're in a row right now. We're on a row. What time is it? Give me 1 second, guys. It's 9:22. All right, we're good to go. After a father purchases a life insurance policy in a teenage daughter and adds a payer benefit rider in which of the following scenarios will the rider waive the payments of the rider? Well, D. Yes, that is definitely the answer. So let me type it up and then screenshot, and let's find out why. For those of you that didn't know. Okay, so right here, I'm going to highlight the benefit right here. This is what you got to know. This is what they're talking about. Okay. Payer benefit rider. What is it? Payer benefit rider is exactly the answer. If the father becomes disabled for 6 months, then what's going to happen? The rider waives the payment of premiums. See that? So if the father becomes disabled for 6 months, what's going to happen? That's going to happen. The rider waives the payment of premiums. What does that mean? What is a premium? The premium is a monthly payment. So that means that the client has free insurance as long as the father or mother is disabled. Does that make sense? All right. So that's it. There's nothing else to learn here. Good job, whoever answered that. Didn't recognize your voice. Let's go to the next one. Number 7. Which of the following is not allowed in credit life insurance? A, creditor requiring that a debtor buys insurance from a certain insurer. B, creditor having a collateral assignment on the policy. C, creditor requiring that a debtor has a life insurance. D, creditor becoming a policy beneficiary. Which of the following is not allowed on a credit life insurance? The creditor becoming the policy beneficiary. It has to be, because if the debtor dies, the creditor gets the money. That was D. So D is not one of the answers, because that one's true. C, creditor requiring that a debtor has life insurance. Yeah, a creditor could require that a debtor has life insurance. That's what credit life is all about. B, creditor having a collateral assignment on the policy. Creditor having a collateral assignment on the policy. I don't know. And A, Justin says the answer is A. Let me go back to the chat. There we go. A says creditor requiring that a debtor buys insurance from a certain insurer. Ooh. Híjole. Yeah, I think that's right, man. I think it's A. Yep, it is A. So a creditor cannot require that a debtor purchases insurance through a specific insurer. See that? So it cannot be a certain insurer. It has to be anywhere, anyone, any other. Whoever the client chooses. It doesn't have to be like, boom, this one. Make sense? All right, let's go to the next one. We're good to go. We're good to go. We're on a roll. Number 8, a return of premium term life policy is written as what type of term coverage? A, renewal. B, renewable. B, level. C, increasing. D, decreasing. Return of premium. This was question number 1, guys. All right. Question number 1. What's the answer? I'm not going to answer this one. You guys should know this one because this was question number 1. Go ahead. Speak up. Unmute your mics. Go for it. Shoot.
Increasing.
Increasing. Anybody else want to double it? Maria says C2. All right. We got 2 on C. Anybody else? China. How many people do we have on the chat? 6? Maria, Justin, okay. All right, guys, it is definitely increasing. Good job. Good job, good job, good job. So remember, guys, remember this. Just remember this, okay? Remember over and over. Just make the connections here. Return of premium, increasing, term insurance, okay? Return, or ROP, also known as ROP. So just remember those 3 things. Term insurance, return of premium, increasing, ROP. Got it? All right, got it. Let's go to the next one. Number 9, an insured has a life insurance policy that requires him to only pay premiums for a specific number of years until the policy's paid up. Paid up, okay? Anytime you hear the word paid up, okay? Anytime you hear the word paid up, that means that it's a what? It's a whole life, okay? So just make the connection right there. Okay, whole life. What kind of policy is it? Limited pay life, variable life, adjustable life, or graded premium life? What do you think, guys? What do you think, guys? What do you think? What do you think? What do you think? All right, so let me tell you, man, for sure, it's not going to be variable life. Okay, and it's not going to be adjustable life. Remember what is also known? Adjustable life is a universal life, because universal life is flexible, premium, adjustable life. You see adjustable life right here? Adjustable life right here. You see why it's important to learn that universal life is the same thing as flexible, premium, adjustable life? Right there, man. See, you're already killing 2 answers right there that are wrong. D is a graded premium whole life. Graded premium is a type of whole life, and limited pay is a type of whole life. So A and D are whole life policies. But right here, they're talking about something that you pay for a specific period of time, and then it's paid up. And the answer says it. Look at A. A says limited pay life. Beautiful. The answer is A. The answer is A. The answer is A. The answer is A. Got it, guys? This is good, man. This is good. You guys are learning. You guys are learning. Let's go to the next one. Number 10, which of the following is a key distinction between variable whole life and variable universal life products? Variable whole life and variable universal life products. A variable whole life allows policy loans from the cash value. B, variable universal life has a fixed premium. C, variable whole life has a guaranteed death benefit. And D, variable universal life is regulated solely through FINRA. Solely through FINRA. Which of the following key distinctions between variable whole life and variable universal life products? All right, so variable whole life, this one's a good one. Let's keep reading. Any suggestions? Maria, is that D for number 10? I don't know if that was for 10. Yeah,
no, it was for the previous.
One? Okay, yeah. So I got a little tip, and it's you, Maria, and everybody else. If you could participate, please do so. Okay, it's for your good. So right here, always put, like, if you're answering for 10, just put 10A. See what I mean? Oops.
Okay.
Wrong one. 10A. Boom. There it is. Just like that. Okay, cool. Oh, I typed in an answer and I didn't mean to do that. Okay, so let's do it. The answer is C. Variable whole life has a guaranteed death benefit. Guys, go ahead and screenshot this one. This one comes out and it always gets me, man. I've seen it like 3 or 4 times and I can't seem to get it right. I wouldn't have chosen C, but anyways. Variable life has a guaranteed death benefit. So whole life, variable whole life has a guaranteed death benefit, and variable, got it. Okay, so let's screenshot this. Let's read it. Okay, so right here, variable whole life always has a guaranteed death benefit. Always has a guaranteed death benefit. That means that it doesn't matter. It's gonna pay the death benefit what it started. Universal life doesn't have a guaranteed death benefit. Why? Because it's flexible, premium, adjustable life. So the life insurance is adjustable, and therefore, if it adjusts, then there's no guarantee death benefit because it adjusts. You could adjust it up or down, little bit or a lot of it. See what I mean? Let's read the rationale together. Variable universal life insurance may or may not have a minimum death benefit, unlike variable whole life, which guarantees a minimum death benefit. All right, let's go ahead and go to the next one. You guys got this? You guys screenshot it? All right, let's go to the next one. Number 11, in a survivorship life policy, when does the insurer pay the death benefit? A, if the insured survives to age 100, B, upon the last death, C, upon the first death, or D, half at the first death and half at the second death. 11B, B, yes. You guys have been studying. That's good. All right, so check this out. Check this out. Upon the last death, just think of the word survivor. The survivor is the one that dies last, right? The survivor is the one that dies last. So it's upon the last death, the survivor's death. Pretty cool, right? That's a like, if I was in your shoes, that would be an easy way to remember this, guys. Yeah, that's an easy way to remember that. All right, let's go to the next one. Number 12. Number 12 says, to sell variable life insurance policies, an agent must receive all of the following except. So right here it's talking about variable, right? You need to have a securities license for variable. You need to have a life insurance license for variable. And you need to work with, and you need to have a connection with FINRA. All right, so right here, the answer is D, okay? To sell variable life insurance policies, you need FINRA, you need securities license, you need a life license, okay? You do not need the SEC to get involved. That's a regulatory agency, yes, but it governs other type of things, not like people that are securities licensed. They govern more like fraud of securities, white collar crimes of securities, okay? So go ahead and answer that question. I mean, screenshot that question. Awesome. Nice. Okay, we missed one question, which was the variable whole life. Let's review it. There it is. Okay, which of the following is a key distinction between variable whole life universal life products? Is that variable whole life has a guaranteed death benefit. Okay, let's go ahead and close this and let's go attack a different one. So I'm gonna go to main menu. I'm gonna go to the middle section, click OK. I'm gonna go to study by topic and then go to the introduction. And let's check out at the bottom, which is a big chunk of the test. Right now, which one did we do? We did life insurance. Nope, not that one. We did types of policies, and there's going to be 10 questions on the exam, which is the biggest one, dude. That's why I like to go over types of policies, because it's a big chunk of the exam. But right now, we're going to do 12 questions on the other 10, which is the individual life insurance contract. Okay. And I want you to screenshot this, okay? This one, you got to do it. This one, please do it. Please master it. Master that one and master that one, okay? You got to master those. If you don't master those, you're dead. Your chances of you passing are very small, slim to none, all right? I'm not being negative. I'm actually being positive. You know, I am positive you will fail if you don't study. See that? It's pretty positive, right? Okay, let's go to the next one. Let's go to the individual life insurance contract. All right, let's go to the main menu. Oops, cancel. Let's go to the main menu. Let's go to middle section. We're gonna go to chapter quizzes, and we're gonna go to the individual life insurance contract. There it is. Life insurance, individual. Here we go. There's 10 questions on the exam on this section. All right. The clause that protects the proceeds of life insurance policy from creditors after the death of an insured is known as Spendthrift clause, beneficiary protection clause, incontestability clause, or beneficiary protection clause. Benefit protection clause or beneficiary protection clause. Ooh. Go ahead, type in your answers. or answer it in your brain. Ready for this? I'm gonna give you the answer in 3, 2, 1. The answer is A. Spendthrift clause. There's nothing to teach here on this one. This is just a definition. So go ahead and screenshot it and don't forget about the spendthrift clause. You know, spendthrift clause. Spendthrift clause. What is this talking about? So let's say I'm married with Noemi, right? So if I die, and let's say we owe $50,000 in credit cards, let's say. And if I die, my wife is going to get, let's say, $1 million in coverage that I have. And then the creditor is going to be like, cha-ching, give us our $50,000 back plus interest. While the spendthrift clause protects my wife from having to give the money to the creditor to pay the $50,000 that we owe, or that I owed. You see what I mean? So that's what the spendthrift clause protects: my wife's money from my debt, and I'm dead. You know what I mean? All right, let's go to the next one. Number 2, which of the following components must a life insurance policy have to allow policy loans, cash value, dividends, flexible premium, face amount? Okay, so this one says a component that a life insurance policy have to allow policy loans. Loans have to do with the cash value. It has to have cash value. If it has cash value, then you can pull out a loan. If it doesn't have cash value, you can't pull out a loan. You can't get a loan. Okay, so you basically, it's crazy. It's your money, but you're gonna borrow your own money. It's a loan. Crazy, right? You're not lending yourself money. The insurance company is getting your money and lending it to you. Crazy. It's legal. Can you believe that? It's legal. It should be illegal. It's a ripoff. Number 2, which of the following, oh, by the way, on the test, they're not going to say, is this a ripoff? Is this illegal? Is this unethical? They're not going to ask you that, because they just take a neutral stand, you know. They just want you to pass the test. They don't want to get involved. Which of the following components must a life insurance policy have to allow policy loans? A, cash value, B, dividends, C, flexible premiums, or D, face amount? Which of the following components must a life insurance policy have to allow policy loans?
A.
Did we just go over this one?
It seems very similar as the previous one.
Yeah, this is like, what the heck's going on? Okay, anyways, let's go to number 3. An insured will be allowed to reactivate her lapsed policy if action is taken with a certain period of time and proof of insurability is provided. Which policy provision allows this? Waiver of premium provision, incontestable clause, grace period, reinstatement provision?
Grace period.
Grace period. An insurer will be allowed to reactivate her lapsed policy if an action is taken within a certain period of time and proof of insurability is provided. Ooh, let's talk about this. All right, so check this out, guys. And I'll give you a hint. It is not grace period. But I'll talk about what is grace period, because it's good to learn. There's a lot to learn on this question. Actually, this is called, the answer is D, reinstatement. So let's talk about it, okay? So right here, let's analyze the question here. The question says, an insured will be allowed to reactivate, reinstate. There it is. This one is good enough, but let's get more in depth, okay? Here's another one. It's already lapsed, okay? So the grace period works like this. It gives you 60 days of grace, right? Of forgiveness to catch up with your payments. Okay, so if they allow you 60 days to catch up, is the policy lapsed or is it still active? Right? If they allow you to catch up, that means the policy is still active, right? So right here, the policy is still active. Okay, Right here, it's saying that it's lapsed already. So you could cross out C. You see what I mean, guys? That's how you want to do it. Life insurance policy, if action is taken within a certain period of time and proof of insurability, check it out. Here's another hint. You need proof of insurability. Proof of insurability. So it's lapsed and you have to show that you're healthy because it's lapsed, but you could reactivate it. It's called reinstatement. Incontestability. What is incontestability? Let's use a different color for this. B. What is incontestability? Incontestability is that in the first 2 years, it's contestable. Contestable. What does that mean? What that means is that the policy, the insurance company could check out for fraud, because could contest the policy if there was fraud involved. So I buy a policy, I have cancer, but then you ask me the medical questions, do you have cancer? And I say, no, I don't have cancer, but I do. And then the policy gets issued because I lied, and then I die 2 months later, or 1 year later, or 1 year and 11 months later. If it's within the 2 year period, the insurance company could check it out for fraud, and then they're going to find out that I lied, and then they're not going to pay the benefit. They're not going to pay it. It's going to be declined. Why? Because there was fraud, right? That's incontestability. And now you know what grace period is, and now you know what reinstatement provision is. Okay, so let's go to the answer. It is D. A lapsed policy may be reinstated within 3 years by paying back premiums. There you go. You have to pay back premiums with interest, and you have to provide insurability. All right, let's go to the next one. Number 4, Jay applied for life insurance policy on January 10th. The policy was issued in January 31st. Jay's agent was vacationing at the time the policy was issued. So Jay did not receive the policy until February 18th. Jay decides that he does not want the policy. When would Jay need to return the policy to the insurer in order to receive a full refund of premiums paid? A, anytime because the agent did not deliver the policy promptly. B, February 28th.
B.
What was that?
B.
B. All right. Let's see. The policy was issued first. The agent was vacation at the time the policy was issued. Did I receive the policy until February? February 18th. Whoa. Or 10 days after the policy delivery day. I like B2. The time varies from one policy to another. Anytime because the agent did not deliver the policy promptly. When would Jay need to return the policy to insurer in order to refund? Anytime. I like A too. It was already too late when Jay received the policy because of the 10-day. No, it's not D for sure. Okay, let's go. Anybody else? 4B. Okay, let's go with B. You guys are ganging up on me. The 10-day free look period begins when the policy is delivered. Yes. Good job, champions. February 28th or 10 days after the time the policy is delivered. Ooh, yeah, that sounds right now. All right, good job, guys. Keep on going. Let's go we got 15 minutes left. All right, number 5. When calculating the amount of policy may borrow from a variable life policy, what must be subtracted from the policy's cash value? Mortality cost, the cash surrender amount, outstanding loans and interest, the face amount. When calculating the amount the policy owner may borrow from a variable life policy, what must be subtracted from the policy's cash value? What must be subtracted from the policy's cash value? The face amount, the amount outstanding loans and interest, the cash surrender amounts, or the mortality costs? B. I'm gonna go with C, man. I think this one is C.
I'm sorry, C.
C. Okay, not a problem.
C. I put it the wrong in the chat.
Oh, okay. Yeah, not a problem, Maria. Don't worry. So why? So if you owe any money, so let's do a little bit of math here, okay? So let's say the cash value is $10,000, okay? But the client pulled out a loan from this money pulled out a loan of $3,000. And he owes interest of $200. So these two is 3,200 minus $10,000, right? So 3,200 minus 10,000 is 6,800. So what's available for cash for loan? 6,800. That's how much money is available for loan, right? So it's the cash value subtracted from the policy's cash value. What's subtracted minus the policy's cash value? Well, whatever is owed and an interest. Pretty cool, right? It's good. All right, guys, let's go to the next one. Let's continue here. Let's keep on going. Let's keep on moving forward. Number 6, if an insured under a variable life policy dies, how will the insured respond to the outstanding policy loans? Well, if the person dies, the policy loan amount is charged to the beneficiaries. The loan is waived. The loan amount are deducted from the death benefits, or the policy is withheld until the payments are met. All right, go ahead and choose your answer in your brain on out loud or in the chat, and then I'm going to type my answer. C. The answer is C. The loan amounts are deducted from the death benefit. All right, let's understand this one. Okay, so here's oops. Okay. So here we go. The client has $15,000 in oh no, I was talking about loans. Give me 1 second. Let me go back. The client pulled out from his cash value, he pulled out $7,000. Okay. And the face amount of the policy is $200,000, let's say. And then the client dies. Right? What happens? Will the beneficiary receive $200,000 and then has to pay the company? No. The beneficiary, before he receives the money, first you have to subtract and then you get the money. So the beneficiary is going to get 200,000 minus 7,000, which is 193,000. Make sense? That's how it works. That's crazy, right? It's their money. Why are you taking it away from the benefit amount? It's crazy. In the event the assured dies, any outstanding loans or accrued interest deducted from the policy proceeds. Loans cannot exceed the cash value on the policy. Next one. We're almost done. Which of the following is true about non-forfeiture values? A table showing non-forfeiture values for the next 10 years must be included in the policy. B, policy owners does not have authority to decide how to exercise the non-forfeiture value. C, they are required by state law to be included in the policy. D, they are optional provisions. Which of the following is true about non-forfeiture values? Non-forfeiture values. Well, this one, your guess is as good as mine, so go ahead and guess.
C.
All right, you know what? Let's go with C. Why not? Viva Mexico. Yeah, C. Good job. Non-forfeiture values are required by state law to be included in the policy and cannot be altered by the policy owner. A table showing the non-forfeiture values for the next 20 years must be included in the policy. Screenshot it. Chinese to me. Good luck. You don't need to get them all right, by the way, so don't worry if you don't understand it. Let's go to the ones that we do understand and let's learn from them, because you just need a D. Were you at least a D student in class, in school, or were you an F student? You were a C student. So see, you're gonna pass this. You see, you're a C student. Which of the following settlement options is life insurance? Which of the following settlement options in life insurance is known as straight life? Single life, life with period certain, flexible life, life income. Ooh, this is a good one. What do you guys think?
A.
I'll give you a hint. It's either A or B.
I'm guessing A.
You're guessing A. All right. I like A too. Let's go with A. Oh, I was wrong too. The life income option, also known as straight life, provides the recipient income that he or she cannot outlive. It pays a benefit while the beneficiary is alive. However, the payments stop at the beneficiary's death. Okay. So here we go. So straight life, life only, also known as straight life. Oh, it's the same thing, right? Life income option. There it is. Boom. So no single life. That one got us. That one got us. That one got us. You want to screenshot it? Go for it. All right, let's go to the next one. What type of settlement option? The type of settlement option which pays through the lifetimes of 2 or more beneficiaries is called joint and survivor, fixed period, fixed amount, joint life. The types of settlement options which pays through the lifetime of 2 or more beneficiaries is called
D. Joint life.
Ooh, wait. I'm gonna give you a tip. It pays throughout the life.
I'd say A.
2 or more. So it's gonna pay if the joint life pays 2, but if one of them dies, the survivor gets nothing. But this will look at the question. It's asking, which of the following pays the lifetimes of the 2? So yes, the answer is definitely A, because it pays not only the first one to die, but the second to die as well. Remember, survivorship life is second to die.
Oh, the joint life only pays the one, right? And then it just expires or
so
cancels.
Here's husband and here's wife.
Mm-hmm.
On a joint life, let's say it's paying $3,000 a month. When the husband dies, or the other way around, the payments stop. So the wife is going to be without payments. On joint and survivor, right? So let's erase this. So joint and survivor, here's husband, here's wife. If the husband dies, the $3,000 still keep going to the wife, and then the wife dies, then the payments stop. Okay, so and that's what the question is asking right here. So that's this is a good one. This was a good one to learn. I love it. Screenshot that, guys. Screenshot that. All right. What type of account will most likely be established for a minor? Trust, annuity, credit life, estate planning. What type of account will most likely be established for a minor? A minor. Dang, this is a good one. I would say A. Let's try A. Yeah, trust account. Trusts are commonly established for minors or to create a scholarship fund. Oh, yeah. Okay, I get it. It's not going to be on the test, but I mean, what I was going to say is not going to be on the test because it's more of a securities thing. But this might help you remember this, okay? When you open a minor account, it's called the Uniform Gift to Minors Act. Oops, sorry. Let me see. It's an UGMA or an UTMA. Okay? This is not going to be on the test, okay? But this is how you could remember this. You see this little T right here? This stands for Uniform Trust to Minors Act. Uniform Trust to Minors Act. These two things are the same thing, okay? It's a minor account. But right here it says trust, and there it is. Trust. Okay? So hopefully that one helps right there. Let's go ahead and go to the next one. Let's see if we could do it, 2 of them in 4 minutes. 2 per question. When a policy designates a group of individuals as the beneficiary of a life insurance death benefit without specifically naming the individual's life is called A, revocable designation, B, irrevocable designation, C, Stirpes designation, or D, class designation. So what's the answer here? When a policy owner designates a group of individuals as a beneficiary of life insurance death benefits without specifically naming the individual, this is called the D, class. Yeah, I like it. I like class designation. Good job. Good job, whoever answered. Was that you, Alondra? Screenshot this, please, guys. This is good. This is a good one. So it's without specifically naming, so it's not naming individuals. So it's going to be a class, like the whole group. Okay. So for example, when I talk about class, when it talks about class, it's talking about preferred class. So it designates groups, right? This group is preferred. This group is standard. This group is substandard. Okay. All right, let's go to the next one. Last one, and then we're done. All of the following are true regarding insurance policy loans, except a policy loan can be made on policies that do not accumulate cash value. The amount of the outstanding loan and interest will be deducted from the policy's proceeds when the insured dies. The policy will terminate if the loan plus interest equals or exceeds the cash value of the policy. Policy owners can borrow up to the full amount of their whole life policy's cash value. All of the following are true regarding policy loans, except policy loans can be made on policies that do not have cash value. Heck no. Definitely A. You remember, if there's no cash value, can you borrow money? Pues no hay dinero, right? There's no money, so you can't borrow. You can't get no cash value. You can't do a loan if there's no cash value. And that's what A is saying. A is saying is policy loans can be made on policies that do not have a cash value. And that's not true. That's not true. So there it is. That's the answer, because it's asking all of the following are true except. Got it? So let's review B, C, and D, because they're true, and that's good to learn. B says the amount of outstanding loans and interest will be deducted from the policy proceeds when the insured dies. Yes. I think that was like 3 questions previously. C, the policy will terminate if the loan plus interest equals or exceeds the cash value of the policy. Yes, it will terminate. Policy owners can borrow if the full amount of their whole life policy's cash value. So if the cash value if the whole life policy has 30,000 in cash value, then the policy owners can borrow up to the full amount, the whole entire 30,000 of the cash value. All right. Okay, I think we're done with this. What do we get? I like to see what we get. 91%. We missed the question. Let's review the question and then we're done. It says, which of the following, the list of all the questions that you missed. Oh, wait. Which of the following settlement options is in life insurance is known as straight life? And the answer is life income. Boom, shakalaka. All right, we are done. All right, don't leave. What I'm gonna do is let me find out, okay, if you are part of this chat group. Okay, let me know if you're not, because if you're not, then I gotta make sure that you're added to this. Okay, so Alondra, before you leave, what's your last name, Alondra?
Gurrola, Gurrola.
Alondra. Oh, you're not part of the group. Okay, Alondra, check this out. I'm gonna text on the chat. You see that number right there? 760-501-2536.
Yeah.
Save that number in your contacts. Okay, and then I want you to text that number. Text team to that number. And,
okay, I'll do that right now.
And Maria, you're in with that, okay? Right? Yeah, you are. Okay. Yeah, just text in team, and then we're good to go. Justin, are you in this? I think you are.
Sure.
Let me see. Let me look for you. Oh yeah, you are. You are, brother. Oops. Alondra. Yeah, that's it. All right, guys, we're good to go. Thank you very much. Have a great night, and I'll see you tomorrow.
I do have a question before we leave.
Yeah, go for it, Maria.
When we get the real test, is that the same questions that we've been studying on the quizzes and others, or do they change
questions?
Or do they change them, the wording and stuff?
Yeah, they change them, but the concept is the same. You know, the concept is the same. This is an insurance test. It is nothing more and nothing less. All right. So if you study it, you will get it because the concept is the same. But I'm glad you asked that, because if you memorize the questions, that's not a good strategy to pass this test, because they're not going to be the same. So thanks for bringing that up. That's a really good question. Okay. What other questions do you have, guys?
I actually just wanted to input on that. Well, there's some questions that you're gonna see that is like, some of them are, I could tell you that they are like, all right, they're kind of like the same, because when me and Johnny were practicing, I was like, all right, it was kind of like, for me, I felt like it was like a driving test. When the practice test that you take, they're similar, but it's of course not the same, but there's a bit of it. It's not the majority of it. There's only like a few that's going to be like maybe the same. But honestly, guys, it's the reason I felt it the first times, I wasn't really like, you know, but now that I actually got into it, I could tell you right now that the questions are not that hard. They're more harder than the practice. They're harder in the practice test than they are in the actual one.
Yeah. So they are very similar, and they might even change the names, like the names of the people, like if they say names, but they're, you know what, I have heard, all right, so I took this test 18 years ago, but I have heard that there are questions word by word the same, but it's like 1 or 2 or 3 of them out of 80. You know what I mean? So I would not, I would not bank on that. Okay, I would not bank on that. Just study the concept, and you will get similar style of questions, but not exactly the same. Not exactly.
Okay. Well, thank you so much.
What else?
Have a good night.
Anybody else? Have a good night.
Have a good night. Thank you.
All right. Bye, Mariana Londra.